The safest bond market in the world just became a battlefield. January 20th, 2026, Japan's 40-year bond yield spiked 30 basis points in one morning, a move that used to take a month. Prime Minister Takaichi announces Y21.3 trillion stimulus, and Japanese insurers begin selling 1.1 trillion in US treasuries. You might think this is isolated to Japan. Bad timing, right? Wrong. There's a mechanism that destroyed the British pound in 1992, Asian tigers in 1997, European bonds in 2012. It just activated in the third largest economy. Snap election February 8th, BOJ meeting January 31st, 11-day window. Hedge funds call this the explicit warning, and the pattern is three-quarters complete. When bond vigilantes attack a heavily indebted nation, there are only two choices. Choice 1. Defend the currency. Raise interest rates. Let bond yields explode. Watch your banking system collapse under the weight of debt service. Choice 2. Print money. Buy your own bonds. Suppress yields. Watch your currency collapse. And inflation destroy savings. There is no choice 3, and history proves this repeatedly. September 16, 1992, Black Wednesday. Bank of England tries choice 1. George Soros and hedge funds bet billions against the British pound. The BOE raises interest rates from 10% to 12% in one morning, then to 15% by afternoon, trying to make the pound attractive enough that investors stop selling. They burn through 15 billion in foreign reserves buying pounds in the market. 8 hours later, they surrender. The pound crashes 15% overnight. Britain gets forced out of the European exchange rate mechanism. The political establishment calls Soros a villain, but Soros didn't break anything. He simply recognized that a heavily indebted government cannot defend its currency. When the math doesn't support the defense, the mechanism executed exactly as predicted. Thailand and Indonesia tried choice 2. The Thai baht comes under speculative attack. Instead of raising rates and immediately crushing their economies, they print. The Bank of Thailand prints baht to intervene in currency markets trying to hold the exchange rate stable. Indonesia does the same with the rupiah. Within 6 months, the baht collapses 50%. The rupiah falls 80%. Why? Because printing more of something makes it worth less. And when you're a small, open economy that imports everything, currency collapse means imported inflation. Indonesia sees prices rise 70% in a single year. Food riots break out. The IMF steps in with emergency loans, but the conditions are brutal. Slash government spending, raise interest rates retroactively, accept foreign control of banks. Printing to escape didn't work. It just determined which kind of collapse they got. Greece tries both strategies simultaneously. First, they raise taxes and cut government spending to prove fiscal responsibility. Doesn't work. Bond yields hit 30% anyway. Then the European Central Bank secretly prints euros and buys Greek bonds through back channels to suppress yields. Also doesn't work. Greece requires 3 separate bailout packages totaling 289 billion. Mario Draghi finally has to promise whatever it takes, essentially unlimited ECB money printing, to stop bond yields from exploding across Spain, Italy, Portugal. And even with all that, Greece loses 25% of GDP and an entire decade of economic growth. Both choices led to disaster. Now, apply this to Japan. If the Bank of Japan picks choice 1, defend the yen by raising interest rates to 3% or 4% to compete with rising JGB yields, here's the math. Japan's total government debt is $1,200 trillion at the current average yield of about 1.2%. Annual interest payments cost Wenberg $14.4 trillion. Manageable. But if the BOJ raises rates and the average yield across all government debt rises to 4%, which is where 40-year JGBs are already trading, annual interest costs jump to $48 trillion. Japan's total annual tax revenue is $20 trillion. That means 40% of every single yen the government collects in taxes goes straight to interest payments. Not healthcare, not pensions for the oldest population on Earth, not infrastructure, not defense, just interest on old debt. And with 30% of the population over 65, Japan cannot cut pensions without riots. They cannot raise taxes more without killing what's left of growth. Choice 1 doesn't work. So, choice 2. Choice. The Bank of Japan prints Y50 trillion or Y100 trillion, whatever amount necessary, and uses that newly created money to buy Japanese government bonds directly, holding yields down by force. On paper, this solves the debt service problem. In reality, currency markets react instantly. The yen is already trading at 160 per dollar, weak by historical standards. If the BOJ announces another massive QE program, the yen goes to 180, maybe 200 per dollar, and Japan imports 85% of its energy and most of its food. A 20% further collapse in the yen means 15% to 20% inflation on everything Japan buys from abroad. Energy prices double, food costs spike. A population that has experienced zero inflation for 3 decades watches their savings lose purchasing power in real time. And once inflation expectations break, once people stop believing the yen will hold value, the spiral becomes self-reinforcing. Everyone tries to spend currency before it loses more value, which accelerates inflation further. Choice 2 also fails. What about choice 3? Wait for external rescue. Greece waited for the ECB. Southeast Asia waited for the IMF. But who has the resources to bail out a $9 trillion bond market in the world's third largest economy? The IMF's total lending capacity is under $1 trillion. The Federal Reserve will not print dollars to buy yen and JGBs. China, dealing with its own property crisis and holding $3 trillion in reserves, is not going to rescue Japan. There is no choice 3. Japan is simultaneously too big to fail and too big to save. And bond vigilantes have forced them to choose between 2 disasters. Right now, if this pattern feels familiar, hit subscribe because we're about to show you exactly how the dominoes fall when the third largest economy on Earth faces the bond vigilante firing squad. Let's walk through January 20th, 2026, minute by minute. This wasn't random volatility. This was a coordinated revolt. 9:47 a.m. Tokyo time. Prime Minister Takai announces YA 21.3 trillion stimulus, the largest in Japanese history, and calls a snap election for February 8th. Markets pause for 12 minutes. 10:15 a.m. Japanese government bond yields explode. The 40-year JGB jumps from 3.94% to 4.09% in 28 minutes, 15 basis points. Normal daily movement is 3 or 4 basis points. This is 5 times that in half an hour. 10:43 a.m. First circuit breaker triggers. Trading halts when volatility exceeds thresholds. Resume of 5 minutes later, yields keep climbing. 11:18 a.m. Second halt, yields hit 4.18%, 24 basis points in 91 minutes. Traders are saying unprecedented. Bloomberg terminals flash red across Asia. 11:30 a.m. Third halt never happened before. 3 halts in one session. When trading finally stabilizes, 40-year yields reach 4.24%, 24%, 30 basis points higher than the open. A move that normally takes an entire month just happened in under 2 hours. Behind the scenes, Japanese life insurers are recalculating. They hold $1.1 trillion in U.S. treasuries. The old logic, JGBs yield nothing, so buy U.S. treasuries at 3% or 4% hedge currency risk. Earn the spread. But now JGBs yield 4%. U.S. treasuries yield 4.3%. After paying 50 basis points to hedge currency risk, U.S. treasuries net 3.8%. JGBs pay 4% with zero currency risk. The trade has inverted. One's RPM emergency meetings at Nippon Life, Daiichi Life, Maji Yasuda. Together, they control over $1.1 trillion in U.S. treasuries. The decision is unanimous. Sell U.S. treasuries, buy JGBs. It's not politics, it's math. Why take currency risk for lower returns? 3-hour ppm, Tokyo time. 1-hour am, New York time. U.S. Treasury markets open. 10-year yields spike from 4.18% to 4.31% in the first hour, 13 basis points. The market knows what's coming. Over $1 trillion in forced selling, and bond markets hate forced selling by large institutions. 6 RPM Tokyo time. European bond markets open. German bonds jump 18 basis points. French OATs, already under pressure from pension strikes, surged 22 basis points. Italian BTP spiked 31 basis points. Pure contagion. Not from European news, but because Japan's anchor moved and every ship in the harbor started drifting. 9 TAS RPM. Emerging market currencies cascade. Thai baht drops 3.2%. Korean won falls 2.8%. Philippine peso loses 2.1%. Why? Because Japanese capital has funded carry trades across Asia for years. Borrow yen at zero, invest in higher-yielding Asian bonds, pocket the spread. Now, as yen strengthens with capital returning home, those carry trades unwind violently. Forced liquidation across the region. The Nikkei closes down 2.1%, but it had been down 4.7% intraday before a mysterious late rally. Rumors circulate that the Bank of Japan bought YY 2.3 trillion in JGBs during the session to prevent collapse. Unconfirmed, but the price action suggests someone with unlimited firepower intervened. An anonymous Tokyo bond trader tells Reuters, "This is not a market, this is a revolt." A hedge fund manager in New York, "Japanese insurers are explicitly telling Washington, your deficits are no longer our problem." A Bloomberg terminal note, "The carry trade just unwound 18 months of positioning in 6 hours." 40-year JGB yields 3.94% to 4.24%, yen 155 to 160 per dollar, US 10-year treasuries 4.18% to 4.31%. European bonds spiked. EM currencies collapsed all in one day, one announcement, one session. This wasn't random. This was coordinated capital flight. And when $1.1 trillion moves in 6 hours, someone knew something 6 weeks ago. The math makes escape impossible. Japan's total debt is Y1,200 trillion, approximately 9 trillion. GDP is Y600 trillion. Debt is 250% of GDP, the highest ratio of any major developed economy. And in a rising rate environment, this number is a mathematical death sentence. Current average interest rate, 1.2%. At that rate, Japan pays Y14.4 trillion per year in interest. Japan's tax revenue, Y20 trillion. 12% goes to debt service. Uncomfortable, but manageable. The government can still fund healthcare, pensions, infrastructure, but the 40-year JGB now trades at 4.24%. If bond vigilantes push the entire yield curve to 4%, interest payments jump to Y48 trillion per year. 40% of every yen in taxes goes to interest alone. Not schools, not hospitals, not pensions for the oldest population in the developed world. Just interest on old debt. Make this tangible. Imagine your household earns $120,000 per year, but your mortgage interest alone is $48,000 annually. And you still have to pay for food, utilities, healthcare, your kids' education, car payments, insurance, and you cannot default on the mortgage. You cannot sell the house and your interest rate keeps rising every month. That is Japan's position right now. There is no budget cut that solves this. The hole is too deep. History gives us two options. Both lead to disaster. Option 1, financial repression. The United Kingdom tried this after World War II. In 1946, UK debt was 250% of GDP, almost exactly where Japan is today. The Bank of England kept interest rates artificially low, well below inflation, for 2 straight decades. Real interest rates were negative 2% to 4% throughout the 1950s and 1960s. Government bonds lost purchasing power every single year. Savers were slowly destroyed, but the debt got inflated away. By the mid-1970s, UK debt had fallen to 100% of GDP. It worked technically, but an entire generation paid the price. Savers lost 60% of their purchasing power over 30 years. If you retired in 1946 with $100,000 by 1976, it could only buy what $40,000 bought in 1946. That's financial repression. You don't default. You just make the currency worthless enough that the debt becomes manageable. Option 2, austerity. Italy tried this in the 1990s. In 1992, Italy's debt hit 120% of GDP. The LRA came under attack. Italy was forced out of the European exchange rate mechanism. Bond yields spiked to 14%. The government had to choose default or cut spending. They chose austerity, cut government spending by 7% of GDP, raised taxes dramatically, accepted EU bailout terms that included foreign oversight of fiscal policy. Brutal. Unemployment spiked above 12%. GDP growth collapsed. Even after all that, it took 15 years to bring debt back under 100%. Japan's trap is worse than both. The UK in 1946 had a young population, growth ahead, and empire remnants to tax. Italy had the European Union to bail them out. The ECB could print euros and buy Italian bonds when yields hit 14%. Japan has none of that. Japan has the oldest population in the developed world. 30% of citizens are over 65. The workforce is shrinking, there is no growth on the horizon, and there is no one to bail them out. The Federal Reserve will not print dollars to buy yen and JGBs. The IMF doesn't have anywhere near the resources to stabilize a $9 trillion bond market. China, with its own property crisis, isn't rescuing anyone. Japan is simultaneously too big to fail and too big to save. And here's the most dangerous element. Japan has run near zero interest rates for 30 consecutive years. An entire generation has never experienced sustained inflation. Savings accounts pay effectively zero. Bonds pay zero. The Japanese population has been psychologically conditioned to believe holding yen is completely safe. But if the Bank of Japan prints Y50 trillion or Y100 trillion to suppress bond yields, the yen collapses. It's already at 160 per dollar. Aggressive money printing could push it to 200. And Japan imports 85% of its energy and most of its food. A 25% collapse in the currency means 15% to 20% imported inflation. Energy prices double. Food prices spike, and once inflation expectations break after 3 decades of zero inflation, the spiral becomes self-reinforcing. Everyone rushes to spend currency before it loses more value, which increases the velocity of money, which accelerates inflation further, which makes everyone want to spend even faster. It's not just an economic spiral, it's a psychological break. And once that break happens, it's nearly impossible to reverse without draconian interest rate hikes that would bankrupt the government. Japan isn't choosing between good and bad. They're choosing between slow death and fast death. Financial repression slowly destroys savers over decades. Austerity collapses the economy immediately. Money printing triggers currency collapse and runaway inflation. Every path leads to disaster, and bond vigilantes just force Japan to choose. Right now, when the anchor breaks, every ship in the harbor drifts. Japan has been the anchor of low rates for 30 years. Now it's breaking. Who's next? Start with the contagion mechanism. Japanese life insurers hold $1.1 trillion in U.S. treasuries, largest foreign holder after China. For 3 decades, the logic was simple. JGBs yield nothing. U.S. treasuries yield 3% to 4%. Hedge currency risk, pocket the spread. Worked perfectly, but it just inverted. JGBs now yield 4%. U.S. treasuries yield 4.3%. Hedging costs 50 basis points. Math. 4.3% minus 0.5%. Hedging equals 3.8% net. JGBs pay 4% with zero currency risk. The trade no longer works. Japanese insurers will sell $1.1 trillion treasuries over 6 to 12 months and buy JGBs. Repatriation trade. Who buys those treasuries? Fed stopped QE. China reduced holdings $300 billion since 2022. Europe and Middle East maxed out. No natural buyer means yields rise. Treasury must offer higher rates to attract buyers. Every 50 basis point rise costs U.S. government $180 billion yearly in interest. U.S. has $36 trillion debt. If 10-year yields go from 4.3% to 5%, annual interest jumps from $1.8 trillion to $2.5 trillion. U.S. tax revenue, $4.9 trillion, 51% to interest. One bad auction away from Japan's trap. Treasury Secretary already complained publicly. Recent movements in Japanese capital markets are destabilizing global bond markets. Diplomatic for stop selling our bonds, but Japan isn't attacking. The math changed. When a trillion moves on math, politics can't stop it. Target 1, United States. 36 trillion debt, $2 trillion deficits yearly, losing Japan as buyer. Same pattern hit UK in 1976. Britain running deficits, foreign buyers stopped. IMF bailout with brutal austerity. Could happen to US. Target to United Kingdom. Post-Brexit, lost EU backs, stopped debt 100% GDP. Pension funds scarred from 2022 LDI crisis. Trust announced tax cuts. Gilt yields spiked 100 basis points. Pension funds face $200 billion margin calls. BOE emergency QE trust resigned in 44 days. If global yields rise and gilt spike another 100 BPS, same margin calls. BOE forced to print again. Market stops believing BOE can control yields. Target 3, France. Macron's pension reform triggered strikes, political instability, debt 1 or 10% GDP rising. OAT spreads over German bonds widened from 40 BPS in 2023 to 80 BPS now. Market charging France more for political risk. If vigilantes attack Japan successfully, France is next. ECB no longer has 2012 credibility. Not clear they can defend France. trigger February 8th election. Takechi wins. Stimulus confirmed, yields rise. Opposition wins. They promised even more stimulus. Yields rise anyway. Election isn't about if, it's about how fast. Game theory. You're a Japanese insurer portfolio manager. Election coming. After election, JGB yields higher. Everyone sells treasuries. Do you wait and sell into falling market or front run and sell now while price is high? Rational move? Sell first. Selling accelerates before election, not after. February 8th is trigger, but repositioning already happening. US viewers, this decision made in Tokyo. Your savings, bonds, pension, 401k on the line. Japanese insurers sell 1.1 trillion. Treasury prices fall, yields rise. Everything from mortgages to corporate borrowing to government costs goes up. Fed could print to buy treasuries, but that reignites inflation. Or Fed stands aside, yields rise. Borrowing expensive, recession risk, no good option. Japan's crisis becomes America's crisis mechanically. When the anchor breaks, every ship drifts. Right now, $36 trillion US debt is drifting. 11 days, 3 trigger points. Bond vigilantes watching everyone. January 31st, Bank of Japan monetary policy meeting. Will they intervene? Print money to buy bonds, yen collapses, imported inflation accelerates, raise rates to defend currency, debt service explodes, budget crisis, do nothing. Yields keep rising until something breaks. No good choice, only different disasters. February 8th, snap election results. Takechi wins. Why 21.3 trillion stimulus confirmed? Yields rise, opposition wins. They promised why 30 trillion, yields rise anyway. Election isn't about whether this happens, it's about how fast. February 15th, next major JGB auction. Why 2.7 trillion in 20-year bonds? First auction after election. Market watching, who shows up? Strong demand means insurers rotating from treasuries to JGBs. Weak demand means failed auction yields spike shockwaves globally. 11 days, 3 events. Outcome determines if crisis stays in Japan or spreads. Connect the pattern. Same mechanism broke Bank of England 1992. Soros forced Britain out of ERM. Pound crashed 15% in one day. Same mechanism collapsed Asian tigers 1997. Thailand, Indonesia, South Korea lost 50% to 80%. Needed IMF bailouts with brutal austerity. Same mechanism nearly destroyed Eurozone 2012. Greek, Spanish, Italian, Portuguese yields exploded. Only Draghi's unlimited ECB intervention prevented collapse. That mechanism executing in Japan, now stage 3 of 4. This time is different. Britain 1992 wasn't systemic. Pound wasn't reserve currency. Asia 1997 was emerging markets. US and Europe provided bailouts. Europe 2012 was dangerous, but ECB could print unlimited euros. Japan is third largest economy. Japanese investors hold trillions globally. Yen is major reserve currency. No institution has resources or mandate to bail out Japan. IMF can't. Fed won't. China has its own crisis. Too big to fail, too big to save. When Japan hits stage 4, contagion doesn't stop at borders. This isn't a Japanese problem. This is global debt. Japan is first domino, most leveraged at 250% debt to GDP, most vulnerable to rising rates. But when you're running trillion-dollar deficits like US or issuing 100-year bonds like Austria or holding currency union with negative rates like ECB, you're next. Mechanism doesn't care about politics or intentions. It executes when math stops working. What do? Understand so-called safe assets, government bonds, risk-free treasuries aren't safe when vigilantes revolt. Understand holding assets in currency whose government prints to service debt is choosing financial repression. Understand by the time mainstream media calls this crisis, repositioning is complete. Smart money already moved. Pattern doesn't require belief. It executes. Those who see pattern while executing, not after collapse, can position accordingly. Your instinct, something's wrong with global debt. You're right, Japan proving it now. You're seeing this 11 days before election. Mainstream covers it 11 days after, not prediction. Pattern recognition. Pattern 3/4 complete. Subscribe to see what happens when vigilantes force third largest economy to choose between currency collapse and banking crisis. February 8th triggers stage 4. Unlike 1992, 1997, 2012, this domino is big enough to take the global system with it. Comment below. Takaichi wins. Does Fed intervene to support Japan or let them fall? If this pattern made sense, if you see the mechanism, hit like. Next 11 days determine whether you understood before your savings evaporated or